So this video is going to be addressing some comments that I got on a previous video that I was talking about stocks versus real estate, and I kind of wanted to explain why real estate is actually almost always going to yield you a higher return on investment compared to stocks. Now, if you pick individual stocks or if you do other things in the stock market or you're better than 95% of retail investors, sure, stocks might be a better idea. But for the average person, real estate often results in higher yields, higher return on investment if you do something like house flipping. So there's lots of opportunity and different angles to take on real estate. I'm going to specifically focus on like what's the most traditional real estate investment, which is just passively purchasing a home, renting it out, and with the market appreciating by a certain amount every year, what the return on investment looks like when you do that. So I recently had a conversation with someone and they showed me this really cool spreadsheet tool that I think you guys might actually find pretty interesting. It's a AI spreadsheet, which is honestly pretty cool and I think a pretty good use of the technology. It's something that's actually like viable and useful. You can see like if I scroll up here a little bit, I have done a bunch of prompting. It's kind of still in like a beta stage, so it's not perfect just yet, but it's super powerful. You can connect it to different APIs. And if you want, like let's say that it runs code on something. Oh, I want to see like my mortgage amortization, and you go and you try to mess with the code and you're like, oh, something's not working. You can literally just press this big red button that says fix, and it will fix itself for you, which is just like crazy. You actually don't have to know how to code to do this. There was one thing that I ran into where knowing how to code was useful, but other than that, like it's pretty crazy how powerful this thing is. So for example, like on the second sheet here, I had it create this entire like mortgage amortization schedule for me. And then you go back here and it's like same idea. I had it actually set up this entire spreadsheet. In this example, I'm going to take a under average priced home in Toronto. So $800,000 purchase price, 20% down payment, which is $160,000, which means you need a loan for this much. Right now, the best interest rates that you can find are about 4.24%. We do 25-year mortgages here, although now 30-year is a thing. Brings us to a monthly payment of $3,463. And you can see some of the Python code over there that popped up on the side. So this is the Python code, and then this is me confirming the calculation using the normal function. So you can do both. Rental income, I assumed for this price home, you would probably get like in downtown, like a 2-bedroom condo. So you could probably fetch around $2,800 and then let's say $100 for like the parking spot or something. So we're at $2,900, 5% vacancy, which we can factor in using this effective income. And then we need to calculate that as an annual amount. So that's what I did here. This was crazy actually for the property tax. I had it find me like the property tax, and it's basically using like ChatGPT. So it can't quite search the web yet. So it's using data that it already has, but it was really close to the right number for the property tax calculation, which I was very impressed about. And insurance, it also, like, I was like, can you give me an estimate of insurance? And it gave me a pretty solid estimate. Like, you do have to be careful because these numbers will vary depending on the property you're buying and depending on how much utilities you're using and what kind of utilities and all this other variables that the AI can't predict. It's cool that you can just ask it and it'll like give you like a reasonable estimate. So total operating expenses, $7,000, mortgage payment. So this is like annual over here. And then total annual expenses, $49,000. And then you look and you say that your annual income was $34,000. So our annual net operating income is going to be negative $14,000 for the first year, which you might say, damn, that's a lot. I can't believe I'm paying $14,000 to keep my property going. Yeah, I know. Seems crazy, right? So let's go to the return analysis where things get even cooler. We have a minus 8% cash on cash return. Nice. So we're not doing great in the cash front. And our cap rate is minus 1.78, which also nice. And our total return on investment from these two things is negative 10%. So good first year, boys. Good first year. But this doesn't factor into the equation equity, which is important. So there's different types of equity that you can build in an investment property. But you have your initial equity, you have your principal paydown, which I ended up calculating over here. The principal paydown, when you're paying your monthly mortgage payments, it's basically what percentage or what amount of that money is going directly towards the principal versus interest. And you can see on my second sheet here that I have a whole like mortgage payment schedule. And this one I did completely with like the Python code. I had the AI write this for me and create these 300 rows for me. The total payment is $3,463 every month. And some of that goes to principal, some of that goes to interest. You can see at the beginning, more of it is going to interest. And then as we get towards the end, it flips. This goes to show you like because the loan is so huge, like a good percentage of the money that you're paying is just interest. So that's why people say like pay off your mortgage faster, because spending less interest on the mortgage. But this is an investment and we're not the ones paying the mortgage, so we don't really care that much in theory. So that's principal pay down. Then we have appreciation in the market. In the Toronto Real Estate Board, the average appreciation has been like 6.7% or something for the last 50 plus years. So I'm being conservative and I'm just saying 5%, okay, 5% appreciation. So between our equity pay down over here of 14,000 and our 5% appreciation, this is the part that people like don't quite understand. Our initial property value is 800,000, right? So we're seeing 5% appreciation on 800,000, not 5% appreciation on 160,000, which if we had put that 160 in the stock market and then we had invested it at like 8% returns, we would be seeing only the appreciation on the 160,000. So we bought an asset that's 5 times the size of the amount of money we put in to get it. We're getting a $40,000 return on that. So like if we took, I'm just going to do this quick calculation, 40,000 over 160,000, that's a 25% return. We would need a 25% return in the stock market to get this equivalent 5% return that we got on our home. So it's pretty big. Like controlling this large asset with leverage it's a big deal. Here you can see I have done 5% appreciation every year for 5 years, and I'm just going to assume a 5-year timeline and then we're going to sell, okay? So 5-year timeline, by the end of it, we're at $1 million, which in 5 years, going from 800 to $1 million is not unreasonable. You can see our cash flows improve a little bit every year, basically because the rent is going up a little bit every year. I made it go up 2.5% every year. That's kind of like the standard rent controlled amount that you usually can increase your rent. It's just about the rate of inflation. So this is inflation and rent, but our mortgage payments will be staying the same, at least for these 5 years. Our principal pay down increases as the balance on the loan decreases, so every year. And then you can see that we start off with $160,000 in home equity, and we continue to build. So this is the appreciation of 40,000 plus our principal pay down equals this plus our original home equity of 160,000. So we add all those numbers together and we get 214, and then we keep doing this. And by the time the 5 years are up, we now have $461,000 of equity. $220,000 of that was just in the appreciation of the property. So another like $80,000 or so was the principal pay down, which is pretty solid. And then another $160,000 was the initial balance. In theory, you could subtract these cash flows, and they do like negatively impact the return. But that's where the next calculation comes into play, which is the internal rate of return. So the internal rate of return is a metric used in financial analysis to estimate the profitability of potential investments. What you do is you have these initial cash flows, right? So let's say in the first year you invested this much and you're projecting like I'm going to make this much in cash flow every single year, and then I'm going to sell it in the 5th year for this much money plus the cash flow in that year. And what this does is it basically comes up with the interest rate that's like implied in these annual cash flows and your exit value. So it takes how much money did I put into this investment? If I have these cash flows and then I sell at this price, what is my annual return rate basically on this investment? Like how much am I making per year averaged? An important term to know as well is net present value, which is basically how much money are these future cash flows going to be worth today. So we discount it, could be the rate of inflation. It could be a little bit higher of an interest rate depending on the percentage that your loan is. It could depend on the risk-free rate, which is we discount using a certain rate in order to bring the cash flows into the present. and that will give us a number. And if that number is greater than 0, it usually means that this is a good investment. So generally, if net present value is 0 or greater, it means that you can't find a better return anywhere else. So a lot of people's internal rate of return on investing in stocks would be about 8% per year, because that is the number that is quoted quite often about how much the stock market should appreciate. So if our internal rate of return is greater than 8%, then we shouldn't be investing in the stock market at all, and we should be putting all of our money into something else. But obviously there's diversification and all this stuff, so don't just put all your eggs in one basket. Let's see what the IRR on our cash flow is. Using Python to calculate it is 14.66%. So that's pretty good. That means that we're making a return of 14.66% annually on this project. And you might be wondering, like, how is that possible? And it's pretty easy to see if you just look at the equity here. So our equity increased $300,000, and we're only losing on average like $12,000 of cash flow per year over 5 years, which is about $60,000. So even if we just do like raw calculation, no discounting or anything. So this was plus 300,000 from when we initially got it. This is minus 60. So we're at $240,000. So our initial cash inputted into this project was $160,000. And if we just do raw math and we don't worry about inflation or discount rates or getting a good return on our investment, we made $260,000 on a $160,000 investment in 5 years. That's more than double in 5 years. And this math keeps going the longer that you make this graph. This house is a better investment than the stock market if our IRR for investing in stocks is 8%. And this is true in almost every real estate investing situation. And I got a lot of comments on the last video telling me like, oh, like, you know, real estate in my market wasn't a good investment. And that's completely possible, right? Depending on where you're investing, maybe real estate just doesn't appreciate in that market. But I'm in a market where it historically has appreciated. And if you look at the policies of the last 30 years, it's going to continue to do so because of a supply and demand problem. So if you're in a market that builds a lot, then yeah, it might only appreciate maybe 2% a year, 3% a year. But where I live, it's been more because we have not kept up with demand and we have not kept up with construction. Even with more construction coming down the line, and if more stuff does come on the market, sure, maybe the appreciation rate will slow down a bit. You can look at the stocks and say, well, you know, over the past 2 years, the returns have been quite good. And yeah, that's true. And if you look at the US specifically, they have been outperforming pretty much every other country in the world. So investing in the US right now has probably never been a better idea when it comes to stocks. You might still see some of these crazy returns in the coming years, but that doesn't last forever. And personally, the nice thing for me about real estate is that it's like a tangible thing. You're buying land, which there's a limited amount of. It's a limited resource. This calculation is discounting, it completely ignoring the amount of work it is to invest in real estate. So the reason that you get higher returns in real estate is because it is more difficult, it is more work to invest in than stocks. Stocks, you just put it and let everybody else do the work. Real estate, you have to do the work. And some people don't want to do that. So you forego a better return. It's not as easy of an investment as stocks. It takes more of a down payment to get into, a higher barrier to entry, right? So it is a more challenging investment to make work. But I think it's important to realize that real estate is a good investment, and it can often be a better investment than stocks if you're willing to put the time and effort in to do so. I'm not saying it's an easy investment. I'm saying if you look at the numbers, there is more room to personally be involved in the real estate investment and personally make it go higher than stocks. In stocks, you're kind of at the whims of what everybody else does, but you have some control, some greater amount of control over real estate. But again, that also means more work. That's kind of the moral of the story here. Like, I think when people say like, oh, like stocks have been better, it's completely possible. Yes, in your market, maybe that's true. But real estate has been a great investment for a very long time. And a lot of people don't do this pro forma analysis. So again, if you want to check out this spreadsheet that I use, if you want to try the AI spreadsheet called Quadratic, you can check out that link in my description. But I think a lot of people don't do this math, and when I tell them, like, you know, you can make 20% a year on real estate compared to 8% a year on stocks, they think I'm BSing, but the numbers don't lie. I just proved that you can lose money every single year, but if the property is appreciating, it offsets the loss in cash. So even if you're paying into a real estate investment, it can be a better investment than stocks, which is really hard to wrap your head around when you're hurting for $1,200 every month that you have to put into this thing and you're going to sleep every night questioning your life choices. I get it, right? Negative cash flow sucks, but if you're in a market that appreciates a lot, then it's worth it. I'm not saying there's no risk. It is risky. Every investment has risk. And if you screw up in real estate or you buy in a bad location or you do all these other things, there is risk and you can lose a lot of money. Just like stocks, there is risk. You can lose a lot of money. So pick your poison pretty much. Fundamentally, the numbers are better for real estate. There's a lot more work that goes into it, but that's kind of the moral of the video. Just wanted to address some of those comments. So hopefully that kind of cleared a little bit up. I don't know if you have other qualms with the numbers or the way I did something, then leave another comment and we can talk about it. But yeah, that's about it. And I'll see you in the next one. Bye.